What if I told you that a single golden retriever outperformed 98% of professional fund managers last year? Well, my furry friend Winston didn't actually pick the stocks, but the 9 companies we're about to discuss have shown such remarkable performance, even a dog could have spotted their potential. Welcome back, I'm Felix, and today we're going to dive into a portfolio so potent it's been turning heads on Wall Street and Main Street alike. In a world where the average investor is lucky to beat inflation, these 9 stocks have been absolute game changers. We're talking about companies with rock-solid financials, innovative business models, and the potential for further explosive growth. And the lesson today, this isn't just about picking winners, it's about understanding why they win and how you can apply these insights to your own investing strategy. Speaking of strategies, our teaching portfolio is also up over 80% this year. That's a $24,000 gain on a $30,000 portfolio. Fancy learning how we do that? Well, I'm hosting a beginner trading training this coming week. It's completely free of charge. I'll teach you how we set up trades, automate profit taking, manage risk, and all that kind of stuff in just a couple of hours a week. If you want to take your investing to another level, come and join us. It's completely free. Link is down below in the description. Now, let's get back to our star-studded lineup. We'll be examining each company's key metrics, from gross profit margins to return on invested capital. Don't worry, if some of these terms sound like gibberish, I'll break everything down in plain English for you. Just think of these metrics as the vital signs of a company. Just as a doctor checks your pulse and blood pressure, we'll be examining these financial indicators to gauge the health of our potential investments. First up, we've got the gross profit margin, or the moat of a stock. I've always liked to describe it like that. Imagine you're running a lemonade stand. You sell a glass for $1 and the lemons and sugar cost you 30 cents. Your gross profit margin would be 70%. In the corporate world, a higher margin typically indicates stronger pricing power and efficiency. It's like your lemonade stand having a secret recipe that allows you to charge a premium. Next, let's talk about another easy one, the operating income margin. This is what's left after you've paid for all your day-to-day expenses. If your lemonade stand operator had to pay for a fancy umbrella and a cooler, these would eat into the operating margin. For big companies, a healthy operating margin suggests they're running a tight ship. Now, here's where it gets a little bit more complex, but stay with me. I promise it's worth it. We have return on capital employed, or ROCE. This measures how efficiently a company uses all its capital, both equity from selling stock and debt from borrowing. It's like assessing how well your lemonade stand uses every penny invested, whether it's your pocket money or a loan from your parents. Similarly, we have return on invested capital, or ROIC, and this narrows the focus to the capital used in core operations. For a lemonade stand, it would ignore any money you set aside for future expansion and focus solely on how effectively you're using the capital to make and sell lemonade right now. The cash conversion cycle might sound like a laundromat term, but it's actually how quickly a company turns its investments into cash. A negative cycle, believe it or not, can be a good thing. It's like if you could sell your lemonade and pocket the cash before you even had to pay for the lemons. And then we have leveraged free cash flow. A leveraged free cash flow margin tells us what percentage of revenue is converted to free cash flow after all expenses and investments. It's the financial equivalent of money in the bank, the cash left over that a company can use to reward shareholders, pay off debt, or reinvest in the business. Before we apply these to our top stocks here, let's touch on a few more metrics that give us insights into a company's financial structure and market perception. And you might want to slow this down and take some notes. I'm aiming to make this as useful for you as possible. Financial leverage shows how much a company relies on debt. It's like assessing whether your lemonade stand is funded by your pocket money or a loan from the bank of mom and dad. The interpretation varies by industry, but generally lower leverage means less financial risk. And then we have the interest coverage ratio. That tells us how easily a company can pay the interest on its outstanding debt. It's like knowing how many glasses of lemonade you need to sell to cover your loan payments. The higher this number, the more comfortable the company's debt position. And lastly, and I know we've run through quite a few here, lastly, we have a few market-based metrics. There is the PE ratio, or the price to earnings ratio. It shows how expensive a stock is relative to earnings, earnings just being a fancy word for profits. A high PE could mean investors expect high growth in the future, or it could mean the stock is overvalued. It's like deciding whether a premium price for your lemonade is justified by its superior quality, or is it just hype? The predicted forward PE ratio looks 2 years into the future, giving us an idea of what investors expect from the company's earnings growth. And speaking of growth, the long-term earnings growth rate gives us an estimate of the expected annual increase in earnings over the long haul. Remember, no single metric tells the whole story. It's the combination of these factors, along with some decent analysis, that gives us a comprehensive view of a company's future health and potential. Now that we've got our financial toolkit ready, and I appreciate if the first time you heard about these, you might be a bit like, whoa, that was a lot. But we'll reuse them for each stock and it becomes a lot more logical, and it'll sort of start to sink in. So let's put it to use and examine our 9 standout stocks here. I promise you, some of these might surprise you. Right then, let's dive into our first 3 powerhouse stocks. I promise you, these aren't just any run-of-the-mill companies. They're the cream of the crop, the top dogs in their respective fields. And speaking of dogs, Winston here has given his seal of approval, which of course means a great deal. He may not understand PE ratios, but he knows a good thing when he sees it or he smells it. So first up, we've got Microsoft. Now, I know what you're thinking, Felix, Microsoft, isn't that a bit bloody obvious? Well, my friend, sometimes the best investments are hiding in plain sight. Let's break it down. Microsoft boasts a gross profit margin of 68% and an operating income margin of 42%. In layman's terms, for every dollar they bring in, they're keeping a hefty chunk as a profit. It's like having a lemonade stand where the lemons practically juice themselves. On top of that, Microsoft's return on capital employed, or ROCE, stands at a whopping 32%, with a return on invested capital of 30%. Essentially, they're turning their investments into profit more efficiently than really anything you could think of. Think about it. You invest $1,000 as Microsoft. Next year, you got $300 profit on that $1,000 investment. That's not bad, right? Imagine you could do that with billions. Well, that's exactly what they're doing. But the next bit is the real corker. Microsoft has a negative cash conversion cycle. Negative. Sounds bad, right? Well, quite the opposite. It means Microsoft is so efficient, they're able to collect cash from customers before they even have to pay their own bills. It's like getting paid for your lemonade before you even bought the lemons, in Microsoft's case, by 17 days. So imagine you got pre-orders for your lemonade 17 days before you had to make and deliver it. That's exactly what Microsoft's business looks like. Add to that an interest coverage ratio of 38 times, meaning they could pay their interest expenses nearly 39 times, actually, over with just their profits. And you've got yourself a financial fortress. Oh, and let's not forget their 100% earnings per share trend score, which means they are consistently increasing their profits per share. A solid long-term growth rate of 15%, which is incredible for a company that size. Microsoft isn't just a tech giant, it's a money-making machine. Next up, we have Intuit. Now, you might not be as familiar with this name, but trust me, they are the unsung hero of the financial software world, and I'm a very proud customer and shareholder. Intuit boasts a staggering gross profit margin of 82%. That's not just good, I can't believe it's not butter good. It suggests they have pricing power that would make even luxury brands jealous. Let's take a look at where Intuit really shines. They have a negative cash conversion cycle of, wait for it, 106 days. 106 days. That means Intuit is so efficient at managing its working capital, it's essentially using other people's money to fund its entire operation for over 3 months. It's like running a business where your suppliers pay you to take their goods. With an interest coverage ratio of 63, and a long-term earnings growth rate of 18%, Intuit isn't just surviving, it's thriving. They're not just balancing the books, they're writing the future of financial management. Last but certainly not least in our tech trio, we have Meta. Yes, the company formerly known as Facebook, Zuck's little toy. Now I know what you're thinking. Isn't Meta just for posting stuff and arguing with your uncle and that kind of thing? Well, let me tell you, there is a lot more to this social media giant than meets the eye. Meta boasts a gross profit margin of 80%, an operating income margin of 36%. In other words, they're turning your likes and shares into cold, hard cash with remarkable efficiency. Their return on capital employed stands at 30%, ROIC at 25%, showing they're not just making money, they're making smart investments with that money. And that's despite all the metaverse nonsense that people are complaining about, right? They are investing insanely efficiently. It's like they've got a crystal ball for what the digital future looks like. Maybe they just build it. But here's the kicker. Meta's current PE ratio is sitting at a relatively modest 25. That's lower than many of its tech peers, suggesting it might be undervalued. It's like finding a designer handbag in the bargain bin, if you were in for that sort of thing. Add to that 100% consistency in growing the earnings per share, indicating strong profit momentum. And you've got a tech giant that's not just connecting the world, but also connecting investors to insane returns. So there you have it. The first three stocks in our power-packed portfolio, each one a leader in its field, each one with financials that would make an accountant weep with joy. But remember, we're just getting started. We've got 6 more gems to uncover, each with its own unique strengths and potentials. Now let's shift gears a bit. We've explored the tech titans, but a well-rounded portfolio needs variety. So let's spice things up with our next 3 stocks. Winston has been particularly excited about these 3. Must be his refined palate. First up, we have Philip Morris International. Now, I know what you're thinking. A tobacco company. But hear me out. PMI, which is their ticker, is actively reinventing itself for a smoke-free future. Let's crunch the numbers. PMI boasts a solid gross margin of 67%. Pays to sell addictive stuff, and an impressive operating income margin of 41%. In simple terms, they're turning a significant portion of their revenue into a lot of profit. It's like having a lemonade stand where each glass costs pennies to make, but you sell it for pounds and it happens to be very addictive. But it gets more impressive than that. Their return on capital employed stands at 56%. That's like insane. It just means you invest $1,000 and in the first year, you get $560 profits on that. That's incredible. They're incredibly efficient at using their own capital to generate profits. Moreover, they have a super high leveraged free cash flow margin of 35%. So think of it as the company's fun money. Cash left over after all the bills are paid, all the investments are made. With a margin this high, they have plenty of financial flexibility to reward shareholders or invest in future growth. Now, I'm not here to debate the ethics of the tobacco industry. That's a personal decision for each investor. And I don't understand why anybody would smoke or why anybody would consume a single one of Philip Morris's products. I think they are incredibly unhealthy. But it's a personal decision. So from a purely financial standpoint, PMI's numbers are hard to ignore. And you know what I love even more about them? Advertising is illegal in the tobacco industry, which means no one else is ever going to build another tobacco company, which means these guys will be the last ones standing and they'll take all the profits. Next up, we've got Stryker Corporation. If PMI is reinventing smoking, Stryker is reinventing, well, their medical technology company specializing in things like joint replacements and surgical equipment. Stryker sports a respectable gross profit margin of 65%. It's kind of like selling bionic limbs for the price of regular ones and still making a tidy profit. Now, Stryker has a rather long cash conversion cycle of 215 days. At first glance, this might seem concerning. Basically means they got to finance their product for a really long period of time. But in the medical device industry, this is not uncommon. Think of it like baking a particularly complex souffle. It takes time, but the end result is worth it. But what's truly exciting about Stryker is its position in the growing healthcare sector. With an aging population and increasing demand for medical technology, Stryker is well positioned for future growth. It's like owning a piece of the fountain of youth. Last, but certainly not least in this trio, we have Visa. Now you might think Visa is just a piece of plastic in your wallet, but it's so much more. It's the invisible backbone of global commerce. Visa's numbers are quite frankly staggering. They boast an eye-watering gross profit margin of 97.2%. Their operating income margin is 67%. In layman's terms, they're printing money. As simple as that. And it gets better. They have a negative cash conversion cycle of 27 days. So they don't even need any of their own money. And remember what we said about Microsoft? Well, Visa takes it to another level. They're so efficient. It's like they're operating in a different dimension of money. With a leveraged free cash flow margin of 56%, an interest coverage ratio of 34 times, and a long-term profit growth rate of almost 18%, Visa isn't just the transaction facilitator. It's facilitating its own stellar financial performance. So there you have it. 3 more powerhouse stocks, each a leader in its own right, from the reinvention of a controversial industry to the cutting edge of medical technology and the very fabric of global commerce. These companies aren't just participants in the industry, they are shaping the future of them. But don't get too comfortable yet. We're in the home stretch now, and I promise you the last 3 stocks are absolute corkers. First up, we have Johnson & Johnson. Now, you might know them for their baby powder or plasters, but J&J is a veritable healthcare juggernaut. I don't know how healthy the products are, but that's again another conversation for another day. They basically have a product for every job out there. So let's look at the numbers. They boast a very solid gross profit margin of 68%. It's like selling a plaster for $1 when it only costs you 32 cents to make it. Not too shabby. But it gets better than that. The interest coverage ratio is a whopping 193x. In layman's terms, they could pay their interest on their debt nearly 200 times over with their profits. It's like having a mortgage payment of $10 a month when you're earning $2,000 a week. What's particularly appealing about J&J is their diversification. With a relatively low PE ratio of 23 compared to some of the others on our list, and a business model spanning pharmaceuticals, medical devices, and consumer goods, J&J is a healthcare department store. They've got something for everyone, and that's a recipe for stability in uncertain times. Next, we have Brown-Forman. Now, if J&J keeps you healthy, Brown-Forman keeps you, well, spirited. They're the folks behind Jack Daniel's whiskey, among many other brands. Brown-Forman sports a respectable operating income margin of 29%. Now, why so low? Well, they actually manufacture a consumer good. Margins tend to be a little bit lower. But it does mean that for every $1 of sales, they still keep 30 cents left after operating expenses. Now, Brown-Forman has a rather long cash conversion cycle of almost a year. At first glance, this might seem not ideal, but in the spirits industry, this is not uncommon. Basically, you got to make it, you got to sell it to a distributor who sells it to a shop or a restaurant who get credit terms. So you are getting paid a year later. Now, what's the benefit of that? It's incredibly hard for new companies to come into the space because they need a heck of a lot of money to get orders. But what's particularly intriguing about Brown-Forman is the potential for improvements in their operations. That long cash conversion cycle suggests there might be room for efficiency gains. And last, but certainly not least, we have Fortinet. Now, if Brown-Forman is in the business of spirits, Fortinet is in the business of, well, protecting your digital spirits. They're a cybersecurity powerhouse providing everything from firewalls to antivirus software. Fortinet's numbers are impressive. They boast a high gross profit margin of 75%, strong leveraged free cash flow of 33%. It's like they're printing money faster than most hackers can say firewall. But it gets better. Fortinet has a sky-high return on invested capital of 35%. That means they're turning every dollar invested into their business into more than 30 cents of a dollar in returns every single year. It's like they found the philosopher's stone of the tech world. And with a 100% earnings per share trend score and the highest long-term earnings growth rate on our list of 19%, Fortinet isn't just protecting digital assets, it seems to be growing them too. Our final three powerhouse stocks, from a healthcare giant that's got your back from cradle to grave, to a spirit company that's been perfecting its craft for generations, to a cybersecurity titan that's growing faster than a computer virus on Windows 95. Now, I know we've covered quite a lot of ground here today, and some of these concepts might seem a little bit daunting at first. We've journeyed from the tech titans of Microsoft, Intuit, and Meta through to the diverse world of Philip Morris, Stryker, and Visa, and finally to the powerhouses of J&J, Brown-Forman, and Fortinet. Each of these companies has demonstrated exceptional financial health. From sky-high profit margins to efficient capital management, they're not just participants in the industry, they are the trendsetters, the innovators, and the ones shaping that future. Now, if your head's spinning faster than Winston chasing his tail, don't worry. Remember, investing is a journey, it's not a sprint. It's about understanding companies, their strengths, and how they fit into the broader landscape. As I always say, every stock represents a company. If you understand the company, you'll make much, much better decisions about stocks. You want to learn more about how we actively trade stocks, then come and join our live trading session next week. And I'll show you how we are up 80% on the year. And I'm not promising you those returns. That would be silly. I'm promising to show you the rules and how I implement them, how we set up the automations, how we put it into the broker, how we spot those trades, and much, much more. So if you're keen to learn how to get better at managing your money, come and join me next week. The link is down below in the description. It's completely free of charge. Now remember that while these 9 stocks have shown impressive performance, it's crucial to do your own research and consider your own personal financial situation before you make any investment decision. Diversification is key, and no single stock should make or break your portfolio. So until next time, keep your portfolios diverse, do your research, do your digging, and set and write out your financial goals. I thank you for watching. I hope to see you on the next one. Today, we're diving into a colossal AI breakthrough that's set to revolutionize not just how we live and travel, but potentially how we invest as well. We'll be exploring the fascinating world of autonomous driving, from self-driving taxis to trucks and even last-mile delivery robots.